Before we move into the third session and everything that follows, I would like to just introduce it a little bit. So to speak a little bit on the third session, which is fiscal governance, tax policy, and revenue administration, I'd like to invite one of our Deputy Research Manager, Yasmin Raji, to the stage.
All right. So, we all would likely agree in this room that it would be misleading to say that COVID alone was the reason for why we are here today as a result of the crisis. Sri Lanka's current economic crisis was a result of a combination of many events that ultimately boiled down to long-standing fiscal governance and policy issues. Much of these issues were and are still rooted in governance weaknesses and corruption vulnerabilities within Sri Lanka's public finance management, tax policy, as well as revenue administration systems. Our presentation today will uncover some of the weaknesses and vulnerabilities that the IMF report identified in these systems at the time of publishing the report towards the end of 2023, as well as selected policy recommendations to minimize them and overcome them. So in the report, the IMF first looks at budget credibility and coverage convergence. In this section, the IMF identified that although Sri Lanka has good budget practices and a good budget process, Sri Lanka's budget can be largely classified as lacking credibility because the budget systemically reports unrealistic revenue and expenditure forecasts and has had very low compliance with existing fiscal rules. All of this boils down to a lack of discipline in the budget process, where massive adjustments to the budget are made by Parliament just before the budget is approved, without regard for fiscal rules, without prior analysis, and without considering the costs and benefits of such decisions. A major reason behind the budget's lack of credibility is that the medium-term fiscal framework, which sets out the government's medium-term fiscal objectives and which the budget is supposed to be based on, is prepared without adequate analysis. Sri Lanka's budget also suffers from a lack of coverage convergence, which essentially means that there is a range of funds outside of the consolidated fund which is not covered by the budget. For example, there are infrastructure projects which are not included in the budget that are currently being executed. And as a result, the budget does not provide a holistic understanding of the use of all public funds and is not transparent about the extent of public revenue generation and spending. So in a nutshell, you'll see the IMF's recommendations onto your right. And they are to submit a new public financial management law that will strengthen the fiscal responsibility framework, budget formulation process, and its execution. They also recommend improving the quality and analytics of the medium-term fiscal framework. And finally, that budget documents are holistically prepared so as to present all of the planned sources and uses of funds for each government entity. The second area that the IMF looks at is public investment management. So currently, the Department of National Planning reviews investment projects proposed by line ministries and includes them in a rolling four-year public investment program, or the PIP, to align public investments with the government's policy priorities. But despite the existence of such a framework, a major weakness that the report identified was that public investment projects as well as public-private partnership projects are identified and approved without regard for what is inside this public investment program. Projects funded in the budget are not always those that are proposed in the PIP either. So all of this has resulted in a situation where scarce resources are being used to fund non-priority projects. So as such, the IMF has recommended that the new public finance management law should include a section on public investment management that will establish a unified approach to prioritizing capital investment projects based on explicit criteria, and that all projects included in the budget will be from the list of assessed and prioritized projects from the PIP. The second weakness that the IMF has identified with public investments is that there is a high incidence of unsolicited proposals that have been entertained for public investment projects and PPPs. The 1998 guidelines for private sector infrastructure projects do allow for unsolicited proposals for PPP projects, but expressly states they cannot be accepted without also inviting proposals through public advertisements. For urgent and exceptional circumstances, the Cabinet is allowed to deviate from this. But what happens in practice is that most PPPs are actually taken up through unsolicited proposals. The same goes for fully funded public projects, public investment projects. The procurement guidelines of 2006 are silent on how to manage unsolicited proposals, which have created a lot of room for this loophole to be misused. So the IMF has recommended that we improve the regulatory framework for the treatment of unsolicited proposals, including the manner in which how such proposals can be received as well as evaluated. They also recommend publishing a list of projects that have originated as unsolicited proposals, including details on the contracted partner, the cost, and implementation progress every 6 months. Within investment management, the IMF also looks at weaknesses in public procurement. They've identified that Sri Lanka has a weak institutional and regulatory framework for public procurement. Currently, there is no public procurement law in Sri Lanka, and all types of public procurement is expected to follow the guidelines that are set out in the procurement guidelines released by the National Procurement Commission. However, these guidelines have been subject to ad hoc and frequent revisions, and there currently exists no unified and updated version of the guidelines for public entities to refer to. Also, there have been multiple changes in the institutional framework for procurement. The National Procurement Commission was first established in 2015 to serve as the sole regulatory and monitory body for procurement. But between 2015 and 2020, both the National Procurement and the Department of Public Finance were involved in the procurement process, until the National Procurement Commission was again abolished in 2020. Thereafter, in 2022, with the 21st Amendment, the National Procurement Commission was reinstated and once again vested with the responsibility to oversee procurement. Finally, procurement guidelines as is do not reflect international best practices in procurement. So the IMF has recommended that the National Procurement Commission's functions be strengthened as an oversight authority for procurement via an 18-month action plan. They also recommend the enactment of a public procurement law that reflects international best practices over the National Procurement Commission's guidelines, so that the breach of good practices will eventually have legal consequences. Another weakness identified with public procurement is that there is a very high incidence of uncompetitive procurement practices in public entities. So as I mentioned earlier, the incidence of unsolicited proposals is very high, and there's also a very high tendency for line ministries and agencies to use non-competitive procedures like emergency procurement to avail themselves of following the procurement guidelines to the dot and allowing them to take advantage of certain situations. There's no way to really understand the true extent of uncompetitive procurement practices in public entities because there is a lack of comprehensive data to ascertain the extent of this. So the IMF has recommended that information on public procurement contracts above 1 billion rupees and contracts that were entered into without a competitive tendering process be published and updated regularly on a website. They also recommended reporting on the progress made in increasing the proportion of competitive tenders in the 10 agencies that had the lowest level of competitive tenders in 2022 on a website. The IMF has also identified that there's a lack of transparency and expertise in procurement practices within public entities. The government has little information on the progress of procurement or the kinds of factors that cause its delays. There is no information available to the public on the award of contracts, and there is little monitoring of the compliance between procurement plans of line ministries and the activities that they set out in their action plans, which create a lot of opportunities for these institutions to misuse funds. Currently, there is no dedicated position of procurement officer in public agencies. The responsibility for procurement usually lies with the secretaries of respective line ministries who perform procurement tasks in addition to the regular responsibilities of their existing positions. So in response to this, the IMF has recommended moving all public procurement transactions to an e-government procurement system by the end of 2025. The IMF also looked at weaknesses in cash management. So, in Sri Lanka, owing to larger than anticipated budget deficits over the years and with limited access to financing, it has been increasingly difficult for the government to ensure that cash is available to meet payments on time. And this results in a situation where the Treasury Operations Department of the Ministry of Finance has had to decide which budgeted transactions can actually get funded and what will not, which essentially means that it is not the parliament that, as determined by the constitution, that decides how the consolidated fund is utilized, but rather the Ministry of Finance. The IMF has identified that an absence of effective commitment controls in cash management has heightened cash rationing practices. Despite financing regulations stating that no commitments are to be incurred unless there is funding for it in the national budget, and that all commitments should be recorded, these instructions are not followed in practice by spending agencies. There has been limited opportunity for the Treasury to exercise any kind of control over these commitments because most of the events that give rise to an obligation are recorded only when a payment has to be made. Modern financial management information systems, which can feature commitment control functions, could help to resolve this. So the IMF has recommended defining a time-bound rollout plan for Sri Lanka's financial management information system, which is the ITMIS, also called the Integrated Treasury Management Information System, and its commitment control function, and to report on its progress. Next, the IMF also looks at internal controls as well as external oversight systems. The report finds that internal controls or audit functions are quite weak and that there is very little data again to determine if they are even functional. The finance regulations and the National Audit Act require establishing an internal audit unit in each department of the ministry at the ministry level. The Department of Management Audit within the Ministry of Finance guides the internal audit functions of these units, but existing information again does not allow the determination of whether functioning internal audit units exist across the government. Although the Department of Management Audit does receive a copy of internal audit reports at the ministry and departmental level, the extent to which these audit findings and recommendations are addressed is also unclear. The Department of Management Audit has developed a set of draft guidelines that reflect a modern risk-based approach to internal audit. These guidelines are supposed to instruct audit and management committees within public entities to make sure and follow up that remedies have been taken to address internal audit report findings. However, the guidelines have not formally been issued up to date. So the IMF has recommended that the DMA's guidelines are officially adopted to strengthen the competencies and capacity of internal audit units. In addition, it has recommended to publish an annual report on the findings of internal audit units and the steps taken to address them. In terms of external oversight, it has found that the Auditor General's Department has little capacity to ensure that findings from the audit reports are actually addressed and taken seriously. So the Auditor General's Department is responsible for external oversight and the audit of public entities. And audits are conducted and reports with findings are then tabled in Parliament and published. The secretaries of ministries are required by law to identify remedial actions in response to the findings of a report by the Auditor General. However, the Auditor General's report indicate common and recurrent weaknesses, which means that little is being done to act on the findings of audit reports. So the IMF has recommended that the Auditor General should be required to submit evidence of corrupt practices to law enforcement or anti-corruption entities that have investigative authority to actually take action on such matters. So the next big section that the report looks at is SOE governance and oversight. The report identifies that the legal framework lacks clarity between non-commercial statutory bodies and commercial SOEs. The government of Sri Lanka maintains ownership and control over somewhere between 300 to 500 entities, but there is currently no official list that identifies what these SOEs are. Also, besides what is stated in the Constitution, there is no specific law that provides clarity regarding what constitutes or categorizes the different forms of public corporations. There is no practical distinction between those entities created by legislation which operate in commercial markets to make profits and those which pursue purely non-market activities, for example, our public universities. So the IMF has recommended publishing an official list of all public entities, distinguishing non-commercial statutory bodies from SOEs, which are commercial entities, and for the new public finance management law to contain a governance framework to ensure a minimum level of management autonomy with a requirement to ensure that internal controls are maintained for non-commercial public entities. The report also identifies that the governance and transparency of SOEs is weak, allowing for the unnecessary politicization of day-to-day operations of SOEs. The process of appointing directors to boards is largely unregulated, highly politicized, and not aligned with selecting people with the proper expertise, experience, and integrity to manage these assets, these state assets. The guidelines that have been issued by the Ministry of Finance is often poorly followed by most of these board of directors. Further information on the identity and background of executives and directors, financial data, annual reports, they are not publicly available, nor are they accessible through RTIs. So there's no mechanism by which these officials can be made accountable for their performance because most appointments are made on a permanent basis. So the IMF has recommended publishing the names of CEOs and board members for the 52 largest SOEs as the names of all executives and directors for all commercialized SOEs. They've also recommended to establish a regulation that sets out the criteria for selecting general directors and board members of SOEs to reflect good practices by nominating qualified individuals with the right kind of expertise, experience, etc. The report also identifies some weaknesses in the ongoing SOE reform policy that needs attention. Although commendable in its aims to address most weaknesses in the governance of SOEs, it still runs the risk of undermining the transparency and accountability of SOEs. The policy envisages passing a modern law for SOEs, along with the creation of a state holding company that will drive comprehensive reforms of state enterprises and the management and governance of state enterprises. But the report says that the reform policy suggests that the holding company will also be responsible for the ongoing operational management of SOEs, and that this could dilute the responsibility and accountability of the board and management of SOEs. In other words, it will add another layer of governance over SOEs that could undermine their transparency. So the IMF recommends implementing the SOE reform policy, but after having addressed key risks of the holding company interfering in operations of the SOEs. The tax policy is another area that the IMF looks into. They've provided a lot of recommendations, but I'm not going to go into each and every one of them because we're running out of time. So basically, the IMF has identified one major weakness in Sri Lanka's tax system, which is that it is highly decentralized and fragmented, which has allowed it to suffer from ad hoc and complex changes over the years and has impacted its transparency and simplicity. So as an example, in 2021, the government implemented an upward adjustment of the personal income tax rate schedules, and they also implemented indirect taxes such as the Social Security levy as substitutes for taxes like the nation's building tax. So most often, these ad hoc changes to taxes have no publicly available explanation or rationale for why they were made. Sri Lanka's tax system has not been based on any rules or on principles of fairness, simplicity, and efficiency, and there's no centralized tax policy unit equipped with sufficient authority to evaluate and explain the rationale behind all tax policy changes. So although the Department of Fiscal Policy plays a central role in the tax system design, it doesn't have a say over the design of all kinds of taxes, for example, the customs duties, or even in like evaluating the projects that should qualify for exemptions in the Strategic Development Act. The report also highlights a few weaknesses with the Strategic Development Act in the fact that it's not transparent in how it evaluates projects for exemptions. And how basically those exemptions impact basically the public finance. So taking all of this into consideration, the IMF has recommended enacting a Tax Administration Act that applies to all taxes and contains provisions that effectively deter corruption, as well as recommending requirements for the Department of Fiscal Policy to issue an opinion on each law, a tax law amendment or new tax act, that they should have authority over the design of customs duties and special commodity levies, etc. They've also recommended to suspend the SDP Act until there's clear criteria on how to evaluate projects and what projects qualify for exemptions, and etc. Finally, we're moving into revenue administration. So with this, the major weakness that the report identifies is that revenue administration is also highly fragmented and dysfunctional and subjected to little oversight. There are three separate revenue collection departments, as you all know, the Inland Revenue, Customs, and Excise departments. But even though they deal with the same pool of taxpayers, they operate with little interaction. There's no clear approaches by which tax expenditure management within these institutions are overseen, because, for example, the Internal Revenue Department has no apparent system to record and track exemptions other than within individual taxpayer files. Also, the Inland Revenue Department has been reluctant to share tax data with the Ministry of Finance to enable them to monitor the outcomes of tax policy measures. So anyway, the IMF recommends to strengthen the Revenue Department oversight and transparency. Another weakness that the IMF has identified with revenue administration is that the institutions, they suffer from outdated and manual administrative and HR processes, which have hindered not only the efficiency and integrity of staff in these entities, but have created loopholes for corruption. The administrative culture and staffing at revenue administrations have halted in time because most of these promotions happen exclusively based on seniority, with no regard for merit, skill, or leadership. And also, despite open acknowledgement that corruption is rampant in most of these agencies, no cases against corrupt tax officials have been made or reported in recent years. So to overcome this, the IMF has recommended minimizing interactions between taxpayers and traders and revenue officials to reduce corruption vulnerabilities. The IMF has also recommended implementing short-term anti-corruption measures within each revenue department. So that brings me to the end of my presentation. Thank you very much for listening, and we'll allow our panel to discuss this issue further. Thank you.